considerations for selection of accounting policies. What points shall be kept in mind at the time of selecting of accounting policy? Technically called considerations for selection of accounting policies. Accounting policies will be selected by management of the organization. They have the freedom. They have the freedom to select accounting policies. Even though they have the freedom, at the same time they have some limitations. They have freedom, at the same time some limitations. Within that limitations, they can enjoy the freedom. Those points are contained in ACE number 1 for selection of accounting policies. What points should be kept in mind by management? Dividing into two parts. Primary considerations, secondary considerations. What is primary consideration? Management has the freedom to select any method, but relevant method shall be selected. By selection of that relevant method of accounting policy, financial statements shall show true and fair view. Whatever the method they want to select, no problem, they have the freedom. Management has the freedom to select the accounting policy, but finally that accounting policy shall show true and fair view of financial statements. After following up the true and fair view, some other points shall also be kept in mind. These are called secondary considerations. One is prudence. 2. Substance over form. 3rd one, materiality. What is prudence? If any uncertainty attached to the future transactions at the time of preparation and presentation of the financial statement, accounting policy which gives prudence, that accounting policy shall be selected. Prudence means, before knowing the what is the meaning of the prudence, human being thinking is dividing into 3 types. One is lavishness. If 1 rupee spending is enough in that situation, but one person spending too much, is spending thousands, even though 1 rupee spending is enough at that situation, that is not correct. Second one is measure. Suppose we have to spend some money for running the organization comfortably, but that person not spending even for the required amount, that is not also correct. In between lavishness and measure, another concept is there in between two, is called as a man of ordinary prudence. As a man of ordinary prudence. Meaning is, if required, definitely he will spend. If not required, he will not spend. That kind of the thinking is technically called prudence. Income will be recognized whenever it is realized only. Realized only. Don't anticipate the profit. It will be, income will be recognized when it is really realized. Yes, next year we are going to generate some income, so I want to recognize income in the current year itself. It is not correct. Example, We have purchased one lottery ticket with 10 rupees. Lottery price is equal to 10 crore. By simply purchasing of the lottery ticket with 10 rupees, yes, I have the chance to get the prize. On that ground, today this 10 lakh prize cannot be recognized. We have to wait till that amount is realized. That concept is called prudence for income angle. And in the case of the probable losses, expenses, for that, any probable losses, probable expenses shall be provided. Example, we have 10 lakh debtors in the balance sheet. We have some doubt on 2 lakh rupees recovery. There is a chance of jumping up that party may not be realized. This is only doubt. Party not gone at all, but I have doubt on 2 lakh rupees recovery. In that case, don't wait till the party jump. Better recognize today itself. This concept is prudence in the case of the probable losses, etc. Second one, substance over form. What is the meaning of the substance? What is the meaning of the form? At the time of preparation of financial statements, definitely we have to follow legality, legal formats, no doubt. By simply following the legal format, neglecting the economic reality is also not correct. All transactions, all accounting transactions shall be recognized, shall be treated based on the economic reality. Meaning is that simply following legal formality, neglecting the economic reality of the accounting transaction is not correct. Much importance shall also be given to the economic reality. That the economic reality is technically called substance. Don't follow simply legality format. Also give much importance to economic reality of the transaction is technically called substantial over form. Example, hire purchase. In the case of the hire purchase, hire vendor will transfer the ownership on the asset to the buyer after last installment payment. Until then, legal ownership is with the vendor. Buyer is not legally owner. According to legality, vendor is owner, legal owner, not the buyer. But in the case of the hire purchase, buyer is selecting the asset. Buyer is paying the money for the entire asset. Of course, entire amount not immediately, over the span of the time in number of installments. Because of the delay in the payment, he is also paying interest also. In that situation, after payment of all installments, hire vendor will transfer the legal ownership to the buyer after payment of last installment. Up to last installment, legal ownership is with the vendor. Buyer is not legally owner. But asset selection, asset using, on the asset risks and rewards, everything is with the buyer only. Right from the selection of the asset, not up to last payment. That is the reason. At the time of selecting of the accounting policy, we have some confusion. Asset will be recognized in the books of the hire vendor. Asset will be recognized in the books of the hire buyer. According to legality, legal ownership is with the hire vendor. That is the reason. According to legality, asset must be shown in the balance sheet of hire vendor only. But according to economic reality, asset selected by the buyer, asset using by the buyer, asset cost is paying by the buyer. Because of the delay, interest is also paying by the buyer. Because risk reward of the asset also with the buyer. This is the economic reality. Based on that, buyer is the owner. That is the reason this asset must be shown in the balance sheet of buyer only. not in the books of the hire vendor. This is based on the concept of the substance of our firm. Third one, materiality. What is the meaning of the materiality? Important things. Important things shall also be kept at mind. According to definition, items the knowledge of which influence the decisions of the users of the financial statements is technically called materiality. What information having impact on the financial statements, on the users of the financial statement, that is called materiality. Example, some wastage of the fund in the organization. Our business size is crores, 10 rupees wasted in the administrative department. This 10 rupees wastage no need to highlight in the reporting because it is very small, negligible matter, insignificant matter. Suppose 100 rupees wasted in the administrative department. No, it is also not having much importance. No need to disclose. Suppose 10 crores wasted. Definitely this is impact on the financial statement. This is also having impact on the users of the financial statements. So this amount is materiality. Finally, I am not saying that 10 lakh or 10 crore is materiality. Compared to size of the organization and nature of the transactions, we have to decide whether a thing is material or not. To decide that whether it is having impact on the users of financial statement or not, that is to be considered. Finally, both things we have to decide at the time of selecting accounting policies. One is a primary consideration, second one is secondary considerations. Primary consideration is that financial statement shall show true and fair view. Secondary considerations are: one, prudence, substance of our firm. Third one is materiality.